Well, good morning. Well, good afternoon, everybody, and welcome for our Lunch and Learn today. My name is Bob Stein, and we'd like to thank Cohen and Company for our co-hosting this today. We're excited to hear about the updates for maximizing loan forgiveness for the PPP loan. Before we begin, we'd like to thank all of IEE's sponsors, PNC Bank, Meyer, Uncle Vic and Scott, UPS, UPMC Health Plan, AT&T, Ensco Long Insurance Group, Wilkie & Associates, C-Level, Net Experts, and again, Cohen and Company for being our continued sponsor and for co-hosting today's session. I'd now like to introduce today's speaker, Jeff Kovacs, a partner at Cohen and Company. Jeff is sought out for his insights and clear explanations. Jeff immediately becomes a valued member of any team. He helps clients identify growth opportunities for their business, focusing on everything from profitability and internal controls to developing and implementing a strategic plan. He is a CPA, and he has his BS in accounting from Penn State. Now I'm going to hand it over to Jeff.
Thank you, Bob, and good afternoon, everybody. Thank you all so much for taking some time today to learn some very important details about maximizing loan forgiveness under the Payroll Protection Program loan. If you're on this call today, I'm assuming that you're a recipient of one of the PPP loans. And as you know, the forgiveness aspects of the loan are critical to all of you as business owners in order to be able to properly plan for your business and the critical impacts that it has on your employees, your compensation, and keeping your business healthy. We're very grateful to the Institute of Entrepreneurial Excellence for giving us the opportunity to share our thoughts on this topic with you today. So our agenda will be to quickly go over the PPP program, to talk about the current loan forgiveness requirements, which were just published on Friday evening. So we've had a busy few days digesting the PPP loan forgiveness application and helping outline some best practices for you. And we'll go through that in quite a bit of detail. At the end, we have some accounting and attestation outlines for you and some frequently asked questions that we may be able to get to. So again, the program overview, I'm not going to spend a lot of time on because many of you, if not all of you, have already applied for this program, and that's why you're here today. As you know, the goal of this program was to provide liquidity resources to employers to permit them to keep their employees on the payroll during the period ended June 30th. This was a loan that was primarily based on payroll. It also covers other non-payroll costs such as interest on mortgage obligations, rent, and utility payments, and is an amount that could be borrowed up to $10 million and has a forgiveness element to it. The loan terms carry 1% interest. If the loan isn't forgiven, if you choose not to apply for forgiveness, it's a 2-year payback period. And some of the attributes of a typical SBA 7A loan program have been changed or modified in terms of borrower and lender fees and the requirement that a company does not have to obtain credit elsewhere to apply for that loan. However, and we'll talk about this in more detail in a moment, one of the other aspects of this loan was the requirement to be able to access other sources of liquidity to support your ongoing operations. Unfortunately, at the time that the loan was issued, that particular phrase was not defined or interpreted, and we'll talk about the impacts of that. The primary topic of today's discussion is how do you apply for loan forgiveness, how do you maximize loan forgiveness, and what are the requirements for you to apply for that and document that. The forgiveness program will begin as the rules are currently written, beginning June 30th, and will end on October 31st of 2020. All of you have seen this definition of payroll costs and what goes into the definition of payroll costs. During the initial loan application period, we spent an extraordinary amount of time helping our clients to interpret that definition of payroll cost and what was included and not included. And we will come back to that definition here in a bit. And as I mentioned, there were some other expenses that were included in the PPP loan application. And as you all know, the intent, again, being focused on payroll, was to limit amounts expended from loan proceeds on these other categories to no more than 25% of the loan proceeds. And again, we'll go through that in detail. And so what are the loan forgiveness requirements? As written today, the loan proceeds can be forgiven during the covered period, and that's an important term that you'll see, the covered period, the 8-week period from the disbursement of the loan through that period 8 weeks later on the items that we've talked about. Any funds spent on anything else outside that 8-week period may result in a reduction of the loan forgiveness amount. And in order to avoid any reduction in forgiveness, a best practice is to spend 75% of the loan proceeds on payroll costs. Some of the most complex aspects of the loan application forgiveness relate to the potential reduction in staff and compensation levels. We've received many, many questions from clients and friends of our firm over the last several months on these provisions and have had to interpret this as you've been trying to manage your business through this period. The loan application that was published on Friday evening provides a significant amount of clarity around that, and we're going to go through these items in detail. So here's what we know, and here's what some of the issues are as we sit here today. As you know, subsequent to the CARES Act being issued in late March, there's been significant interpretation and changes made by the Treasury Department. To date, there have been 12 interim final rules and over 47 frequently asked questions issued subsequent to the Act. All of those are available to you on the SBA website. The phrase that the Treasury is building the plane as they are flying it has been used over and over again, and thus the consternation for all of you as business owners. To give you some metrics, in round one of the PPP loan period, the average loan size was about $200,000, and in round two, it's only about $80,000. And as many of you know, the round two of the funding has not been fully dispersed yet. Perhaps one of the single biggest issues has been the phrase that the companies had to demonstrate that they had adequate sources of liquidity to support the business's ongoing operations. If you could not meet that requirement, then you could apply for the loan, but that requirement had not been defined. And thus, many of you were applying for the loan and then found yourselves reading headline articles in the news that indicated that certain companies were returning these proceeds because there was bad press being issued for certain companies that apparently did not meet the level of having adequate sources of, had adequate sources of liquidity and still applied for the loan. And so the issue here is that at the time that you're applying for the loan, many of your operational issues and the determination of your head count still couldn't be determined. And as we sit here today, still may not be determined as we move forward during this uncertain period. Evidence of your need may still be many months away. So in response to that, the Treasury Department recently said that borrowers with loans greater than $2 million may be subject to audit. And I use that term loosely because they have not defined what level of scrutiny those companies will undergo. They gave companies that took the loan initially the ability to return those funds through the extended due date of yesterday, May 18th. And if the company did so, that particular loan application was deemed to have been made in good faith out of loan necessity. Apparently, borrowers with loans less than $2 million are meeting a safe harbor, and they will have been made to make that good faith certification. When you look at the application that was published on Friday evening, in fact, there is a box that requires you as a borrower to check if you have taken a loan in excess of $2 million. As I said, this application was not issued until May 15th, Friday evening, when many of you had received loan proceeds 45 days or so before that. So you were well into the 8-week covered period by the time any of the loan application guidance was issued. And yet there's still conflicting guidance between the CARES Act legislation, the frequently asked questions, and the application, mostly around the definition of employees, and we'll talk about that. Again, the FAQs published by the Treasury have not fully addressed all of the forgiveness issues, and the Treasury Secretary has indicated that additional technical fixes will occur at some point in the future. So we believe some of those technical fixes may come about through some derivation of the HEROES Act, which was passed by the House last Friday as well. This is the Health and Economic Recovery Omnibus Emergency Solution Act. And there are many provisions in there, but the ones that affect the PPP loan process is that it will allow deductions for the expenses paid with PPP loans that were ultimately forgiven. As this program is currently written, the IRS recently opined on the fact that any of the expenses that were paid from PPP loan proceeds are non-deductible for tax purposes. That is expected to be changed through legislation at some point. But as we sit here today, those expenses are non-deductible. There is a credit in the CARES Act for employers to be able to defer the payment of eligible payroll taxes through 2021 and 2022. However, if you were a recipient of a PPP loan, then you are not able to take advantage of that deferment. We fully expect that that modification will be made to the program as well. There are many types of not-for-profit organizations, for example, 501c6 organizations that have been shut out of the PPP loan process, and we're hopeful that that will be modified on a go-forward basis as well. And two of the most important provisions. As I've already stated, the 8-week period is currently well underway for all of you as business owners, and June 30th will be approaching very quickly during the period that most of these measurements are taking place and that you have to expend the funds. And yet you are in real time trying to make decisions about reopening, rehiring, and restoring compensation levels. And so there are requests made to extend that covered period beyond 8 weeks, past June 30th, and in some cases all the way through the end of the calendar year. So we will have to stay tuned to see if that modification occurs. Also, the requirement that no more than 25% of those costs be spent on non-payroll items is hopeful that we can get that to be eliminated. And so the loan forgiveness application has 4 different components to it. It has a loan forgiveness calculation form, a 1-page form. It has a Schedule A, it has a Schedule A worksheet, and a borrower demographic information form, which is optional. These forms are complex and they are rigorous to complete. We are working on calculators. There are others that are working on calculators to make this easier for you. And my goal today is to try to give you conceptually the concepts in the application to allow you to maximize your forgiveness. As I mentioned, the application expires October 31st, and you can submit it either in paper form or electronically to your lender. There are a number of data points and important metrics that are listed in the application, and you can gather from all of this that those data points will be used by Treasury and by the lender to go through the forgiveness process, and we've listed some of them there for you. And so one of the changes to the program was the determination of an alternative payroll covered period. The issue here was that many borrowers did not know at what point the 8-week period began from their loan disbursement date for them to have to spend the proceeds from the loan on eligible payroll costs. And so the guidance now says that you can use the 8-week period that begins on the first day of the pay period following the PPP disbursement date. For example, if your disbursement date was on a Monday, April 20th, and therefore you could select, if your payroll period began the following Sunday, you could begin counting your 8-week period beginning that following Sunday, April 26th, and that would extend through Saturday, June 20th. So it's important that if you want to align it, we believe it is a best practice for you to align it with your payroll period. You are now permitted to do so. So it's either from the loan disbursement date or that alternative payroll covered date. On this particular slide, you can see the calculation form on the left, Schedule A in the center, and the Schedule A worksheet on the right. As I mentioned, these forms are highly interrelated. The instructions are complex, and you will have to read this carefully. So hopefully our guidance today will at least give you some concepts of how to go about this. So this particular slide talks about an overview of the calculation, and this effectively is that calculation form. And so let me walk you through this quickly, and then we'll get into some of the details. So the very first thing, as you can imagine, is that you need to determine eligible payroll costs that were incurred or paid during the covered period. And we're going to talk about that concept of incurred versus paid. So it does give you the choice of the covered period or the alternative covered period. And then the form walks you through the other non-payroll costs that are all added to those payroll costs. So you have the mortgage interest, the business rent or lease payments, and the utility payments. And so you take 1, 2, 3, and 4, and you add them together, and that becomes your first calculation of the total eligible costs that you will be requesting forgiveness for. The form is clear to state that if you are using the loan proceeds entirely for payroll and you believe that you can meet the forgiveness requirements, you do not need to include any amounts that were paid for mortgage interest, business rent, or business utility payments during that period. You can solely achieve forgiveness through payroll because, again, that was the intent of the program. Once you've added those 4 items together, the first of 2 potential reduction checkpoints appears on the form. And this is very important because what became clear Friday evening was the order in which these potential reductions must be applied in the calculation of the forgiveness. And the first is the potential reduction in compensation paid either to salary or hourly wage individuals for reductions in excess of 25%. That's consistent with the program as originally published, that if compensation was reduced beyond 25%, there would be a potential reduction. There are some safe harbors that we're going to talk about in a moment, and so we will be able to apply those on this particular line. At that point, once all the costs less the compensation reduction have been determined, we have a total eligible cost amount, and then the second of the reduction checkpoints comes into play, and that is for the full-time equivalent reduction. And this, again, has been a significant source of questions during the period in terms of how do I define a full-time equivalent? What happens if I've reduced my payroll? Can I restore people to my payroll? And we'll talk about all of that. At this point, I just want you to be aware that there is a potential reduction in the amounts based on the reduction in headcount over this period. The reason why the form is structured this way is that, again, the intent was to maintain employees on your payroll during that 8-week covered period. So as we sit here today, this is how the form is designed to work. Once you've reduced it for the full-time equivalent, then you have your potential loan forgiveness amount, and then you can take that amount, compare it to your PPP loan amount as a floor, and you also compare it to the 75% of your payroll costs as another potential floor, and you use the lower of those three amounts to determine the full forgiveness amount. That's a lot to digest, and that's on the surface, and that's why the Schedule A and Schedule A worksheet are important to understand. The slides I'm going to go through next are going to go through those worksheets and some of the calculations. So here's some observations quickly. That calculation is conceptually consistent with the previously published guidance, although the order of the application of it has now been clarified. There is a number of definitions and calculations that have been clarified that we're going to talk about, but it continues to provide an incentive for you as a borrower and an employer to spend at least 75% of your payroll costs during that covered period or alternative covered period on your payroll. There are safe harbors to assist you, however, if you can restore wages before June 30th to levels that existed at February 15th. There are many dates that are critical to measure throughout this process, and we'll help you with that. It provides some flexibility for the borrower to choose the average weekly full-time equivalency, and we'll talk about that. However, as I've already said, it still creates problems for you as borrowers that had to make operational decisions and are still making those decisions based on your loan date and now changes to the operations of the loan forgiveness program since that loan date. So we can hope for some of the relief that I spoke about earlier. And as I've already stated, these forms are complex, they're hard to understand, and you have to go through them with a great deal of granularity and with help. Okay, so let's talk about eligible payroll. We've talked about what the components are, and that was clear at the beginning of the PPP process. What was not clear was whether or not this was based on a cash basis or an accrual basis. We received many questions about that. So eligible payroll costs are now defined as considered paid on the day that paychecks are distributed or that the borrower originates an ACH credit transaction to pay that payroll. They're considered incurred on the day that the employee's pay is earned. And as I mentioned earlier, the covered period begins on the loan disbursement date and ends 8 weeks after that or after the alternative period. And so any amounts that are incurred but not paid during your last pay period of those two periods are eligible to be forgiven if they are paid before the next regular payroll date. So that could come into play if you've taken out a loan late in the process and your payroll periods will be running very close to the June 30th end date for the program. As you know, the cash compensation for forgiveness was limited to an prorated annual salary of $100,000, which is equivalent to an 8-week cap of $15,385. In other words, no single employee can use compensation in the calculation for forgiveness for any amounts above $15,385 for that 8-week period. As it relates to the eligible non-payroll costs, again, these costs must be paid during the covered period or incurred and paid on or before the next regular billing date. So for example, even if the billing date is after the covered period, say you've incurred utilities through June 15th, and they're paid on or before the billing date of June 30th, they will be considered eligible covered costs. As we said, those costs cannot exceed 25% of the total forgiveness amount without reduction, and non-payroll costs that were both paid and incurred can only be counted once. Total eligible payroll costs during that period relates to annual compensation to employees, as I've said, based on the 2019 year. And that includes all the things that you already know about as part of the PPP program. It includes employees, owner employees, self-employed individuals, and it also includes the non-cash compensation, such as health insurance, retirement plans, and employer-paid state and local taxes. We're going to talk about the reduction of these amounts in just a bit, though. And so this is based on a quarterly period, January 1 of 2020 through March 31 of 2020, and it's compared to the 8-week covered period. So the clarification is that this is prepared on an individual employee basis. You will need to list and calculate the wages, the salary, and the hourly wages for every employee for which you're seeking loan forgiveness during that period. The application creates the worksheets that I showed you that will require you to conduct those calculations on an individual basis. One of the most significant areas of questioning was what constitutes an FTE in the event that I've had employees that I have laid off, I've furloughed, and I've tried to rehire in order to meet these requirements to keep a certain head count. Do I have to hire these people back? And what happens if these people choose not to come back? The reality is, and most of you have seen this, is that some of these employees that have been furloughed are actually making more on the supplemental unemployment program than they would have been if they were on your payroll. And so the guidance says that you do not have to reduce the borrower's potential loan forgiveness for any reduction in the full-time equivalent head count if you've made a good faith written offer to rehire them during those periods. The employee rejected that, and in those situations where an employee was fired for cause, where they voluntarily resigned, or they voluntarily requested and received a reduction of their hours. If any of these situations have occurred, and you've documented this, and that's a key, then you do not have to count those full-time equivalents against the reduction in head count requirement that we talked about earlier. So as I mentioned in the calculation, there are two checkpoints that we have to focus on for potential reduction. The first is the reduction of compensation. Let's talk about that. There are 3 steps to this, and this can get fairly complex. So I'm going to take a top-down approach and talk to you conceptually about how this should work. So as you know, the goal here is to not reduce compensation by more than 25% during that 8-week covered period. So you look at the average salary, average annual salary or hourly wage during that 8-week period, and you compare it to the quarter ended March 31st of 2020. If the average salary or hourly wage during that 8-week covered period is greater than or equal to that average salary or hourly wage in the first quarter of this year, then there is no reduction in the compensation that can be used for loan forgiveness. So again, that is highly consistent with the original application of the PPP. The challenge is many companies perhaps have reduced compensation levels for liquidity purposes and to be able to maintain the healthy nature of their business. If those wages were reduced in that time period, there is still a safe harbor that you as an employer can meet. And so you're required to look at the annual salary or hourly wage as of February 15th. You must then compare that to the period from February 15th through the end of April. If those February through April wages are greater or less than the February wages, then you will be able to apply for a safe harbor. The intent here is that you've been able to maintain some level of compensation wages relative to February 15th. February 15th is then validated as a point in time for this safe harbor calculation. You then compare your February 15th wages and salary to the salary and wages that exist as of June 30th. And if those wages at June 30th have been restored to February 15th levels or greater, then you meet the safe harbor as a borrower, and there will not be any reduction in the compensation of that individual employee. So it's a very important safe harbor. If you can find yourselves, as the guidance is currently written, able to restore those wages by June 30th relative to your February 15th payroll, you will not see a reduction. If for some reason you're not able to do that, then there is going to be a reduction in those costs that were eligible for forgiveness. And it's a separate calculation, whether it's an hourly worker or a salaried worker. And that calculation is simply looking at the average annual salary or hourly wage during the covered period and comparing that to the first quarter amount multiplied by 75%. If it's less than the 75% amount, it's now created a delta, a difference from the base that must be applied to the hours that an hourly employee would have worked or that a salaried worker would have worked. And we have the calculations there for you. For an hourly worker, you take that delta and you take that amount, multiply it by the average number of hours that they would have worked, that they did work in the first quarter, and multiply that by 8. And that is the amount of wage reduction that will reduce the loan forgiveness during that period. And for a salaried worker, it's a similar calculation where that average salary delta is multiplied by 8 and divided by 52 to determine the salaried worker wage reduction. So as you can see, fairly mechanical, but fairly complicated calculations. But the good news is that there are two ways that you can eliminate the wage and salary reduction, either by paying the 75% amount during the covered period or being able to restore the average amounts by June 30th. So our observations here are that it's using that base period of January through March to drive that comparison through the covered period. If you meet the 75%, you'll be able to receive full loan forgiveness for individual employees. It created the safe harbor that I just talked about, so that hopefully for some borrowers, employers should be helpful. It also gave you the benefit of an alternative covered period, so you can align that with your payroll cycle. And as I said, it is done on an individual employee basis. We'll talk about some best practices around these items in just a few moments. The questions around headcount, timing, and all of those issues have been resolved, but it does require you, as I stated, to gather information based on various data points, various dates throughout that entire period. The question of what constitutes a full-time equivalent has been very challenging, and so the guidance actually makes this very clear for all of us. It essentially says that a full-time employee is anybody that works more than 40 hours a week. So if anybody would work more than 40 hours a week, they're capped at a 1.0. They count as one full-time equivalent. And anyone that works less than 40 hours a week, it will be a ratio of those hours to the 40 hours, and you calculate that based on the 8-week period. So I gave you an example there of somebody under method 1 that might work 35 hours in a week. They would count as a 0.875 full-time equivalent. The guidance also gives you a safe harbor to say that in certain instances where you have full-time equivalents that are working less than 40 hours, by default, you can count them as 1/2, a 0.5 FTE. And so in these particular cases, a best practice would be that if you have a number of employees that are working less than 40 hours a week and actually working less than 20 hours a week, you might want to use the safe harbor of a 0.5 FTE to count them in the calculation of the FTE headcount reduction, because that number will be greater, obviously, than the hours that they're actually working on a weekly basis. And obviously, those that are working more than 20 hours a week, it's to your benefit to use them to achieve the maximum FTE. This is a very critical calculation. As you can recall from the initial loan calculator, the FTE headcount reduction can have a significant impact on this calculation. And so the way it works is you need to look at your total average FTEs between February 15th and April 26th, and you look at your FTEs that existed on February 15th. If the total FTEs on February 15th were greater than those between the 15th and April 26th, then you're permitted to compare that February 15th count to your June 30th count, and you will achieve a safe harbor. The theory there is that, in effect, you've been restoring your FTEs through June 30th, and you will get the benefit of a safe harbor, as long as those June 30th FTEs are greater than the FTEs that existed at February 15th. If if the number of FTEs during the period February 15th through April 26th is less than the February 15th head count, there's clearly been a reduction. And if it hasn't been restored by June 30th, then you have to go through a calculation of what percentage of your FTE head count has occurred. In this particular case, the guidance gives you some chosen reference periods. It says you can compare the FTEs during that 8-week period to the number of FTEs that existed from February 15th of 2019 through June 30th of 2019, or January 1st of 2020 through February 29th of 2020, the first 2 months of this year. And so that could be a benefit to companies that have been growing their head count over the last year, because it's highly likely that your head count, even throughout the reduction period of February through April, could be higher than the same February through June period of 2019. Again, very important calculation to be able to calculate this appropriately. Choose the right reference period and if at all possible, attempt to restore your full-time equivalent by June 30th in order to achieve full forgiveness for the loan. And that's what our observations are right here. Okay. So the next few slides are really just around submitted documentation and other requirements. The most critical components to all of this are the determination of any reduction in compensation and any reduction in headcount. I hope that provided some clarity for you. We're going to go through just a couple of these other slides very quickly to make you aware that they're here. Because you will have these slides, you'll be able to reference these. And this documentation is derived strictly from the PPP application, so you can look at that at your own. So there are definitely required documentation requirements around your payroll, documentation requirements around your determination of full-time equivalents, and documentation around your non-payroll costs. All of those are to be expected. There are certain elements of documentation that you must maintain that you do not have to submit with your loan forgiveness application. And we've listed those for you on here as well. And so one final application matter is that when you apply for this loan forgiveness, there are a number of certifications that you must make to the lender and ultimately to Treasury regarding your eligibility and your calculations for loan forgiveness. These are stated right in the application. We've listed them here for you as well. The important point to know is that you will be certifying that your calculations are complete and accurate. So a couple of best practices for you. Use the loan for its intended purpose, if you can. Obviously, document thoroughly the necessity for that loan so that you can avoid scrutiny, especially if you're a borrower over $2 million. You want to be able to prove that you've suffered some economic damage as a result of these trying times and that the loan was a necessity for you. And we've listed there some things for you to think about in terms of loss of revenue, additional cost incurrence, uncollectible receivables, payables, things along those lines. As we've said, spend as much of the loan proceeds as possible on payroll. In some cases, you may not want to seek forgiveness. There are some companies that are looking at this as a low-cost loan program and not as a government grant. And as we said, it's a 2-year period with a 1% interest rate, which is highly attractive. Some other best practices: align the beginning of the 8-week covered period with the pay period under the alternative covered period date. If you've reduced compensation below 75% compared to the first quarter, see if you can restore that compensation before the end of the 8-week period so that you can get to that 75% floor. If you've reduced it subsequent to February 15th and it looks like your average weekly salary and wages at June 30th are going to be less than that February 15th amount, consider restoring them at levels necessary to raise them to that February 15th level before June 30th. If you furloughed employees between February 15th and April 26th, consider bringing back as many employees as makes business sense as soon as possible so that you can avoid the significant reductions to headcount. That one element will be a primary driver of your loan forgiveness amounts. And also use that simplified method we just talked about for determining FTEs when they're working 20 hours or less. Take advantage of that FTE reduction safe harbor by restoring those levels before June 30th. Make sure you're following all of the documentation requirements to try to rehire employees especially those that have rejected your offer to come back to work, and for those that were fired for cause or who voluntarily resigned or reduced their hours. And finally, work with your payroll provider to obtain these reports. Most of the payroll providers are doing a very good job of crafting reports to make your job easier in pulling this together. One final quick area to talk about the program itself is the accounting and attestation for the loan proceeds. So in accordance with generally accepted accounting principles, there is no authoritative guidance for how to account for this for a business entity. It's our opinion that once you receive loan forgiveness, it becomes a government grant, and it has been already made clear by Treasury that these amounts will not be subject to the government single audit requirements. So you don't have to worry that you will have to undergo a program audit simply because you receive these loan proceeds. Once the amounts are forgiven, they will be recorded as other income for-profit entities. If you're a not-for-profit entity, most likely you will record it as grant income. Our counsel is do not record that loan forgiveness until the debt has been legally extinguished. Or in some cases, there's some guidance that says if you've substantially met the conditions for forgiveness, then you could record the debt extinguishment. Record the paid expenses in your normal expense categories in your statement of operations. Do not offset that grant income with those expenses paid. And then the issue overall around borrowers that receive $2 million or more in proceeds and what level of scrutiny has not yet been determined. We've been talking with the AICPA to provide some services from accounting firms, either to borrowers or lenders under the consulting standards or agreed upon procedure standards to meet some level of attestation if required by Treasury, but we just don't know at this point. And finally, loan forgiveness calculators are being developed. The AICPA released one today, right before we were set to go live with this presentation. I've not had a chance to study it yet, but you can find it on the AICPA website. So with that, I just want you to be aware that there are some frequently asked questions that we have as part of this program as well to try to clarify a few things for you. And with that, I will stop the presentation and take any questions that you might have for me.
This is Ray Vargo, Director of the Small Business Development Center at the University of Pittsburgh's Institute for Entrepreneurial Excellence. Jeff, thank you for that great overview and insight. There's been quite a number of questions submitted by the participants of the webinar this afternoon. So I'm just going to go through some general categories and maybe we could touch upon them briefly. There was a question around payroll processing fees if you use a third-party payroll provider. Can that be included in eligible payroll cost?
That's a great question. My understanding is that it does not meet the definition of a payroll cost. The payroll cost is fairly specific in terms of it meaning cash compensation, contributions that are made for healthcare benefits, contributions made for retirement benefits, and state and local taxes that are paid by the employer for the benefit of hiring the employee.
Yes, so another question was, can contributions to defined benefit plan be included in the payroll cost?
They can.
Yes.
Yes.
And then another question in the same area would be workers' compensation.
Yes, workers' compensation, that depends on the state. So you have to be careful depending on the state that you're in. So it's difficult to answer that thoroughly, but where the employer is paying into a workers' compensation fund, yes, those costs can be included in the definition of covered payroll costs.
Okay, thank you. Question around the use of temporary employees during this period of time. are temporary employees and payment to temporary employees eligible for this calculation?
Yes. So the calculation is based on all employees that you employed during the 8-week covered or alternative covered period. And so whether that temporary employee is working for you full-time or part-time, they will count as part of that FTE calculation. And that's actually a good method, if you can, to raise your head count, your FTE head count, to avoid any reduction in loan forgiveness amounts.
Would they have to be temporary employees of your company, or could you use a third-party temp service?
They cannot be independent contractors. They actually have to be employees.
So you have to issue a W-2, is that correct?
You have to issue a W-2. That's correct. It's been well discussed and well documented that anybody that is considered an independent contractor is not does not meet the definition of an eligible payroll cost.
Okay. If an employee receives overtime payments during this period of time, those are eligible as well, overtime payments?
Overtime payments are eligible. Any level of cash compensation is eligible as a payroll cost. You know, one of the questions we receive frequently is, can I pay bonuses to my employees during this time period? And we cannot find any disallowance of bonuses in the guidance, in the interim final rules, or the frequently asked questions. So it appears that even bonuses as cash compensation qualify. The only thing I would caution you against is that phrase that that you have to be able to meet the necessity of the economic damages in order to receive the loan proceeds. And it might come under scrutiny, especially if you're a borrower over $2 million, to have to explain why you were paying bonuses that might appear that you were using the program to fund bonuses and not through the financial necessity to keep your employees employed.
Another question we had was regarding the $15,385. Is that net or gross for the total amount paid for one individual for that $100,000?
Yes, that is gross cash compensation.
Okay. So you could take the $15,385 and add the additional expenses associated with that as well.
That's correct.
Okay, thank you. We got this question quite a number of times related to transportation costs under the utilities section. We didn't cover that specifically, but I know we've been receiving a lot from our office regarding any guidance regarding what is included in transportation cost under utilities section.
No guidance whatsoever under the FAQs. So it is subject to interpretation. And I think in that particular case, I think you need to look at this as an ongoing, just like you would any utility payment, that if you were paying costs to transport, I believe it's primarily focused on the transportation of anything that you need in order to keep your business in a operating mode, if you will. So it's the base operations of an entity during that time period.
Okay. And maybe a little bit of clarification on lease and rent payments. There was a question related, can you include the lease of office equipment in your calculation?
No, you cannot. It's pretty clear that it is only for the operating structure that you are working in.
Okay, very good. Another question we had is, if a business was not allowed to work, such as some entities, construction companies, other businesses that were not allowed to conduct a business during this time or being open for business, what, from a situation, in order for them to maximize their forgiveness, they still would have to pay their employees during this period of time, correct?
Yes, and that's one of the unintended consequences of this program. We've literally had to say to some of our clients, if you want to meet the requirements of this program, you'll have to pay your employees to effectively sit on the bench. And that really seems counter to what a program like this is intended to do. When you're not permitted to, you're in Pennsylvania, you're in a red or a yellow phase. And as I stated earlier, that's one of the reasons why they're looking to extend the end of this program beyond June 30th.
Yes, and we have time for just maybe two more questions. One is there circles around the concept of if you hire new people during this period of time, do new hires count as part of this calculation of payroll for if you lost employees during this period? So as long as there was a net gain, it still would be included, correct?
That's exactly right, yes.
Okay, very good. Another question related to what happens if you have PPP funds that are unspent at the end of the period of time? What advice or counsel could you provide if we're at the end of the period and there's still some unspent? What can be done?
Well, a couple of things. If they're unspent through payroll or through other costs, then they're going to be treated as a loan. And at that point, there's no provision beyond yesterday, May 18th, to give those amounts back. There has been some discussion that because of the lack of visibility into the future, to have a modification of the program in the future to allow a borrower to return unused funds. We'll see if we're hopeful that would occur. The other part of it is to treat it as a loan and simply at some point repay that loan if you haven't spent it.
Yes. Okay. Very good. We are at the 1 hour mark. We thank Jeff for his expertise and his presentation today. There was a lot of great information. As a reminder, a copy of this presentation will be available to you as well as the video. So this is Ray Vargo, the director of the University of Pittsburgh Small Business Development Center of the Institute for Entrepreneurial Excellence at the University of Pittsburgh. We thank you for your interest and participation in today's webinar. We definitely thank Cohen and Company and Jeff specifically for his presentation. And this will end today's webinar. Have a good day. Thank you.
Thank you, everyone.